Right, good evening. It's 6 o'clock, so we're going to get started with our webinar. Thank you very much for joining us this evening. Tonight's webinar title, as you guys know, Tips to Minimize Your Capital Gain Tax When Selling Property. So good evening, my name is Garth Davis, the founder and CEO of Property Powerhouse. And basically, Property Powerhouse, we are the experts in investment property. And what we try and do is help our clients through the whole entire process of buying property. We help educate and guide our clients through the unknowns of investing in property. We help the clients, including helping them with their finance, their property selection, cash flow estimations, property settlement, property management, building insurance, landlord's insurance, depreciation schedules, you name it, and ongoing support. So that's what we offer our clients and trying to help them with a goal to achieve financial independence and freedom of time. So that's what we do at Property Powerhouse. On our webinar this evening, we have our special guest, who I'm just going to turn to that good-looking man next to me this evening. So good evening, and that is, I'd like to introduce our guest presenter. His name is Nitin Vashisht, from the Director of Tax Store Osborne Park. So Nitin is a CPA, for us uneducated people, a chartered accountant, chartered practicing accountant, and he is a founding director of the Tax Store Osborne Park. Nitin has over 10 years of experience in the building industry in WA and is an expert in property taxation. Nitin is a regular keynote speaker on tax and property and passionate about educating his clients about having a proactive tax strategy to increase their return on investment on the investment properties. Some of the topics Nitin is going to across tonight are, as we had seen in the invite. So good evening, Nitin.
Thanks, Garth.
Fantastic to have you here. I know that you're a key man around property circles,
Yes.
Always busy doing presentations, so we're very grateful to get you this evening. So what can you tell us tonight about tips on minimizing capital gain tax?
Look, Garth, minimizing any tax is very important, more so capital gains tax, because normally that's where you make big money, and that's where you pay a big amount of tax as well. So it's always really a good idea to plan proactively so that you don't pay any more tax than you have to on the sale of your property. So what we are going to be covering today are about few important points. First is, when does a capital gains tax arise? And as you will see later, there is a lot of confusion as to when does a capital gains tax arise. And I'm going to run you through on why that date on when gains tax arise is very important. Now, capital gains tax on main residence. Now, normally we would understand that a main residence is not liable for capital gains tax. That's true, but there are circumstances when you might actually end up paying tax on your main residence as well, or at least a part of it. And also, God, the one question I'm often asked is, how does claiming depreciation on a rental property impacts capital gains? And we will cover that today. And also, I'm going to share with you 5 smart strategies on how you can minimize the capital gain on your property. And of course, we'll be taking some question and answers today. So we ready to rock on? God? All right, this is just a usual disclaimer, people, so that this is just a bit of a general information and does not cover your own personal circumstances. Now, the first question, when does a capital gains tax arise? So a lot of people think that when you actually sell a property and when the property settles, that's when you are liable to capital gains tax. No, wrong. The capital gains liability actually arises when you sign the contract for sale of property, which in practical terms means that offer an acceptance document that you sign with your real estate agent. The moment it goes unconditional, this is when the liability to pay capital gains arise. Now, why is that important? Because this is what determines the year in which you will be paying capital gains. So for example, if you have signed an offer and acceptance for property on June 2019, but your property settles now in August 2019, then guess what? You will not be paying tax in 1920 year. You will be paying tax in this June 19 year. And this is really important because that can throw all your calculations and your cash flow and when you were expecting to pay tax on that important. So it's really very important to take that into consideration and plan it out accordingly. Now, let's move on to the next slide. CGT on main residence. Obviously, we all love our main residence. We all know that the main residence is not subject to capital gains tax, but that happens only when we are using our main residence as our main residence, totally 100%. But the moment we start using our main residence for some income generating purposes, then that portion of the main residence is subject to capital gains tax. I mean, you would often see people renting out their granny flats or putting some rooms on their main residence to Airbnb for earning some extra cash. Now, all that is fine. You make the decision. It gives you some income. But what you need to also consider is that when you will be selling your main residence, the ATO will be treating that part of your main residence as income producing, and you will have to pay full capital gains tax on that portion of your house. So Garth, I mean, for example, if you have been using one room for Airbnb, and when you sell your main residence, you will be paying capital gains tax on that one room that you have been using for Airbnb operation. And the same goes on if you have a granny flat and you are using it to rent it out and making some income from that. So when you sell, then ATO would like to apportion the capital gain to that granny flat and charge you capital gains tax on that. So you might be earning some income, but at the end of the day, you will have to pay capital gains tax on that.
So Nitin, if somebody is using one of their rooms or the granny flat currently, and they want to get clarity moving forward, they should be contacting you or the tax accountant just to get clarity around this.
No, and absolutely. I mean, it doesn't mean that you should not be making money on that today, because obviously that is important, and there are other deductions you can claim. But obviously you need to have that in mind that at some point down the track, when you sell it, there might be an extra capital gains tax component so that you are not hit with a surprise. And moving on, sort of with a similar angle, but a little bit different, a lot of people claim working from home deductions in the tax return. And in this tax season, I'm seeing it every day where people want to claim working from home deductions. Now, that is all right as long as you're claiming deductions for the running expenses like electricity and phone and internet and other things. But the moment you start claiming deduction for working from home for capital expenses like the mortgage you might be paying on the house, then the ATO will treat that you are using the main residence, or at least that room or that study or that portion of the main residence for income producing purpose. So when you will be selling that house, that portion of your house will be subject to capital gains. I usually advise my clients that not to go there, because their benefit in terms of claiming that deduction on working from home expenses, especially the capital portion, is not really going to be much. It doesn't save you much in terms of the deduction. But if you are going to making a big capital gain one day on sale of your main residence, you could actually end up paying a lot more than you have saved in deductions. Again, talk to your accountant, work through that deduction carefully, that whether you need it or not, and take a bit of a long-term view on that. And also, and this point is very, really important, that when your main residence seems to be your main residence, and for example, you might rent your main residence, you might be going overseas, you might be going interstate, or you might buy a new house, a better house, and rent out your own formal residence. Now, this is when you sell that main residence, there will be capital gains implications We'll be talking a little bit later on some strategies that how we can reduce it. But these are the few circumstances, I mean, that your main residence could be subject to tax, or at least a portion of it. The bottom line, the concept, Garth, is that if you are using a portion of your main residence for income producing purpose, whatever that might be, then there are capital gains implications down the track that you must consider. Let's move on to the next one. Now, often you were asking me earlier, Garth, that depreciation, because everyone likes to claim depreciation on the rental properties. Obviously, it gives you some extra cash back. Now, how does it impact when you sell the property? So when you sell the property, the depreciation gets adjusted. So basically, your capital loss gets reduced or your capital gains get increased. So that's really a deduction you have already claimed. So ATF doesn't usually allows you to double dip. But the important point there is that you may or may not have claimed the deduction, but as long as you could have claimed it, but even forgot to claim it for whatever reason, that will still be adjusted. So your capital gain will increase or the capital loss will be decreased by that amount. So that is something you should be mindful of while planning, especially if you have a property to sell or if you have few properties to sell and you're deciding which property will have more capital gains implications. And but often, question arises that should you be claiming depreciation or is it worth it? Now, absolutely it is worth it, because as we will see later, when you sell your rental property, you are eligible to a 50% discount on capital gains. Now, so you are claiming it 100% and you pay at some point in future only 50% back. So absolutely it's worth to claim depreciation on the property. It's a great thing, but just be mindful of the future CGT consequences. Now, this is the main part, Garth.
Excellent, I'm listening.
This is what we're talking about, really, that how to really minimize capital gains. And look, to minimize any tax, and especially capital gains tax, is that you've got to be a little bit proactive and start a little bit ahead, planning ahead, because we can't help you catch the bullet you've already fired, But so the first tip to minimize the capital gains is get your ownership structure right. Now, I cannot emphasize enough, Garth, that how important it is to get your ownership structure right. Now, whether you do it in your name, whether you employ a trust or a company or whatever other, maybe an SMSF to do that, it is extremely important, because using the right structure can really reduce your tax and give you very good asset protection. Now, moving on to that, now, when you sell a rental property, individuals and trusts get a 50% reduction on capital gains, a 50% reduction on capital gains. Now, that is something you must plan for in your capital gains strategy. Now, when I say plan for, means that...
Can I just ask something there, Nitin, and just confirming, that's if you've held the property for X amount of time, is that correct?
Correct, and that is what is in the slide, what I was going to say just now, Garth, that when I say that you must plan for it, that you need to hold the property first for a 12 months period. So that is very important, otherwise you're not going to get it. And then second, you must be holding the property either in your own name or in the name of a trust. If you're holding the property in name of a company, you don't get it. Even if you hold it for 12 months or more than 12 months, if you are holding the property in name of a company, you are not going to get this 50% reduction. So this is why it's very important to plan, hold the property for more than 12 months or at least 12 months, and hopefully you'll be owning it in your own name or in the name of a trust, and you get this 50% reduction. Big difference to your capital gains tax. Now, consider the advantages of a trust, because trust is a very powerful structure. Now, obviously, you need to take advice in your own individual circumstances, but why trust is a very powerful structure is, first of all, a trust has an ability to stream income to your family members that are on a lower rate of tax. So that straight away can reduce your tax significantly, especially if your family members are there on a lower marginal rate, or in some cases can even reduce it to zero. And by using a trust, you still get this 50% capital gains reduction. So it's really a fantastic tool. Cannot emphasize enough. talk to your accountants and see how you can use the power of trust, especially for positively geared properties or where you're going to be paying tax. Now, offer and acceptance. Like I said before, offer and acceptance, or when you sign the contract for the property, is extremely important, because this is the year in which you sign offer and acceptance is when your liability to capital gains tax will arise. Now, you don't want to think that it's only when you settle the property,
Yes,
that's when capital gains tax, because sometimes property can take 6 months to settle or 8 months to settle. It can take longer. But guess what it will do to your cash flow? Because 8 years is going to be asking you for capital gains tax now in this year when you sign the offer acceptance. So very important, don't do that mistake. And one tip, the last one, very, very important, use the 6-year rule very smartly. So
what does the 6-year rule mean?
So simply put, what it is, like we said before, your main residence is free from capital gains tax.
Yes.
But a lot of people will move interstate, or they will move overseas, or they will move into a new home. They've upgraded to a new home. And now that house they used to live in, that was their main residence, is not their main residence anymore.
Yes.
But guess what? What the 6th rule does is that it gives you a window of 6 years, which means you can still treat that house for 6 years as if it was your main residence. So if you move out of your main residence today, so you've got 6 years, that within that 6 years, if you sell that house, you will still get it free of capital gains. How good is that?
It's fantastic, especially if people want to travel, or
Absolutely.
as you say, maybe take a job up north or something for a certain period of time.
Absolutely. Absolutely. And that can literally have a very, very good impact on your bottom line. I mean, you don't want to pay any tax and 6 years is very good enough time.
Yes.
Isn't it?
Yes.
So
we're paying enough tax with all the other things, Nitin. So,
absolutely, mate. Yeah. Absolutely. So let's move on. I think we covered a fair bit, these 5 tips. So I think let's go straight on to question and answers.
All right. So we're making good time. We've received a couple of questions coming in.
Fantastic.
So maybe we'll just push the 2 of us there.
Yeah.
See these 2 good-looking blokes. Okay. All right. So this is one of the questions coming in. Nitin, you mentioned that ownership structure is very important to save capital gains tax on property. So which is the best ownership structure you recommend? And just run those through again. So those could be in your own names. They could be in a family trust or discretionary trust. They could be in a PTY limited.
Yeah.
Joint tenants in common. So what is your recommendation?
Great question, Garth. I get it often.
Wasn't my question, but
that's all right. But it's a great question. It's a great question. People ask me all the time. But the thing is, it depends.
Yes.
Because everyone's circumstances is different. So if your property is, for example, negatively geared, you are better off holding it in your own name. You will get some tax advantages, but just be mindful that when you sell the property, since you're on a higher tax rate, you probably will have to pay more tax as well. And again, trusts are a great structure if you have someone to distribute to. So really, it all depends. Talk to your accountant. You need to take your own personal circumstances into account. But generally speaking, companies will not give you the best advantage, especially from a capital gains point of view, because they do not get the reduction of 50%, and they are not as flexible to stream income as a trust. So your choice usually for most of us is going to be between either holding it in your name or in name of your jointly with your partners or in a trust structure.
Excellent. Right. Another question came in, and there are a couple of coming through here. You mentioned that if you rent out your main residence and we get a 6-year window of to claim it capital gains free, what strategy can we use to reduce capital gains if we exceed the 6 years? And then I've got a different question, so we'll answer that. And there's another question to do with the 6-year rule. But yeah, if we exceed it, what happens? What happens if, I think this person is suggesting maybe we moved up for 7 years. What happens then?
All right. Now, a couple of options. Now, the first option straight away is, like I said, in my tips, plan. So the whole mantra to save you tax is plan, plan, plan. So what you can do is you can move back into your main residence for some minimum time and put it as your main residence again. So what it does is you reset the 6 year again. So just for example, that your 6 years is about to expire. So before 6 years, you moved back in your house, you've lived in it for some time, it's your main residence back again, and then you can fly off again, and your 6 years starts again. So effectively,
yes.
you are now on to
yes.
12 years.
So I could, if we plan properly and I was out for 5 years and 11 months, come back for 1 month, and then reactivates the 6 year rule.
Correct. Look, but there's more to it. Now, if you, for some reason, are not able to do that, then the advice I'll give you is you can use the market, when you sell the property, use the market value of the property on the day you first moved out.
Yes.
As your cost.
Yes.
So what that will straight away do is any gains you have had on that property during the time that you were living in it, it will straight away eliminate that. So you're not paying tax on that.
Again, we need to plan the day we move out, if we're anticipating it to be rented, get a rental appraisal, a fair market appraisal from a real estate agent.
Yeah, and use that market value as the cost of the house.
Yes.
You can do that.
Yes.
And that will reduce your capital gains. And then for the rest of the period, we can do a pro rata. So that again will bring your capital gains tax down by heaps.
Let's keep talking on the 6 year rule. It seems to be attracting a bit of interest. So another question that's come in here from Karen is, does the 6 year rule also apply to an Airbnb? So if we had our main residence and we had a cottage on the property and we were renting that out through Airbnb, the 6 year rule in that space? So
no, I don't think so. It will apply in that case because you are still living in that house. You have not left that house.
Yes.
So effectively what happens in an Airbnb situation, if you have rented out your whole of your house to Airbnb and you have moved out somewhere, then yes, it can apply. But if you are still living in that house and you are using a few rooms to rent out through Airbnb, then it's a different thing. That you are still living in that house and you are using a portion of that house for income producing purposes.
Yes.
The house itself has not ceased to be your main residence.
Yes. All right.
Does that make sense?
I think so. And then we'll ask Karen if we haven't done that. She'll be able to.
Yeah.
We do have your details on the very next slide.
Yeah.
So there we have it. So anything we don't give you a satisfactory answer for today. And just to let you know, we will be emailing out this evening, probably about an hour's time, a video recording of this webinar.
Yeah.
Plus, you've kindly allowed us to use the slides.
Yeah.
So you'll get a copy of the slides. But the whole idea is will you be allowing a 30-minute free consultation to anyone?
Absolutely. Absolutely. Yep. And just a couple of quick questions I see.
Yep.
Hi, Shane. How are you? I see your question, and that's yes, if you move into
Let's read the question.
Yeah.
I heard that 6 year rule is that if you move back into your resident house within 6 years and live for a while, then move out again, another 6 years, and so on, which is what we've just answered.
Absolutely, Shane, that the 6 year rule gets reset, and then you get another 6 years after that, and you can keep doing that,
Right, we've got another question here, and I think I can answer that. You could tell.
Yes.
Tax accountant in training. There you go. Yeah. Obviously, I can give advice on property, but I can't give any advice on accounting. But the question has come through. Hi, Garth and Nitin. I have a property that I've rented out for 3 years, and I haven't claimed any depreciation yet.
Yeah.
What will I be subject to when it's sold? So the first thing I would say is that they can still get hold of me afterwards.
Correct.
We will put you on to one of our preferred depreciation report experts.
Yes.
And partners, and get a depreciation schedule. You can still claim for those last 3 years. Is that correct?
Correct.
So they can claim, whether they claim the depreciation or not, will they still be.
Correct.
I'm assuming it's
the question from Senthil, is it?
I'm talking a bit further up there.
Further up there, yeah.
So get the depreciation schedule. Is that?
Get the depreciation schedule. The depreciation schedule is very important to get. That saves you.
Even if it's 3 years you haven't claimed, you can still claim for 3 years.
Yes, you can go back 2 years. After that, it's a different route. we have to fight with ATO, but the 2 years we can definitely amend your tax.
You need a good accountant like Nitin to go and fight
absolutely,
for you.
Right, absolutely.
Right, a couple of other questions. If I am taking advantage of the 6-year rule for my primary residence, can I still claim depreciation for the 6 years?
Hi, Senthil, thanks for the question, mate. Yes, you can. If you rent out your main residence, you can claim depreciation as normal in those cases. And if you sell your main residence within 6 years, then you don't pay any capital gains tax, but you ended up taking benefit of depreciation in that period, yes.
Right, we got time for a couple other questions. Dilip, I think it's Dilip from,
Hi, Dilip.
From up north, up in Karatha.
Yeah.
Can you convert personal name property and joint tenants into a trust after the purchase, or will this trigger a capital gains event? Or what I would say, that's only half the story. Yes. Then you would have a stamp duty issue as well. So correct. The question is, once you've bought a property in a certain structure and you want to change the ownership because you now want to change it into a trust, does it attract a few?
Absolutely.
Things?
So if you are doing it into a trust, then yes, it will attract capital gains and stamp duty. But if you are just changing the ratio, or if you have it in your own name, but you want to go 50-50 with your wife on that, then yes, in that case, we can handle it differently and you can get away with that. But in most cases, you will be incurring stamp duty and capital gains.
All right, we will answer all your questions, even if we can't cover them during the webinar. We will reply to them after 100%. The event. All right, this is another one of the first ones that came in. What can be a tax strategy if property sells at a loss and the sales price is not enough to pay the mortgage in full? So we're assuming someone's bought a property for 500,000. They'll have stamp duty, probably about another 15 to 16,000, depending on where they've bought it around the country.
Yeah.
And now they go and sell the property for 450,000, for example. Even though you sell the property at a loss, I'm assuming this is a rental property. We've rented out. We've already got our own home, but we have an investment property. It's selling at a loss. They can still be up for capital gains tax.
No, I think if I understand it correctly, it's not about the capital gains tax. Now, Now, if you sell your property, obviously you're doing a loss in this situation.
Yes.
So there is a capital loss. You can carry it forward, that capital loss, indefinitely till the time you have a capital gain on a different property, and then you can adjust that. But if I understand correctly, what is being asked is that if you sell a property at a loss, then frequently it happens that you have a mortgage to pay.
Yes.
And the sale price is not enough to pay the mortgage.
Yes.
So for example, you've sold the house, and after even paying off your mortgage on there, there's still 50,000 or 80,000 still left. So what can be a tax strategy for that? And I tell you, and this is a very good tip, you know, so what you can do in those cases, that interest you'll be paying on the mortgage, you can still claim it on tax. Even though the property is not there anymore, you've already sold the property, but you can still claim interest on that mortgage because it was in relation to and had nexus to that property you owned.
Okay.
So that is going to soften the blow a fair bit, because you can claim tax and reduce your tax.
Okay. So even though the investment property, let's say you only had one property, it's sold, there's still a loan outstanding, you can still claim the...
That's what I'm saying. There is a loan outstanding. The sale proceeds were there. They were not enough to pay the loan because it was a heavily geared property.
Yes.
A lot of people do that. They heavily gear it.
Yes.
So that to claim
at 90%.
At 90%. Yep. So let's say the value had come down by 15%, you know, and it's not enough. So then the interest on that balance, I mean, there are conditions around that. So it's good to see your accountant for that. But you will still be able to claim interest on that, even though the property is not there anymore.
All right. We've got 1 minute to go. That has been absolutely fantastic. I just want to wind up on a couple of things. So a couple of events coming up now for Property Powerhouse. Our next event is going to be on Wednesday, the 4th of September. That will be a live event in Leederville in Perth. It's an education event. We have our financial planner, Ian Van Berg, and he'll be explaining to us why property is essential to have in your investment portfolio, whether you're into shares or Bitcoin or whatever, you need property, and Ian will explain to you why. After that, in October, our event is on Sunday the 20th. We have a Perth property tour, so join us. The invites will be coming out later on that. And then in November, Friday night, the 22nd of November, we have a property investor social event again in Leederville. So we've got some good events coming up, some good things to look forward to. Nitin, it's an exciting time in property. Interest rates are low. There haven't been these big changes which might have come with the election results. So it's still a buyer's market, low interest rates. It's an exciting time for property. Rents are going up.
It is, Garth, and obviously the vacancy rate has come down. I see even in tax returns what we are doing, the rents are moving up, and definitely we see a lot of investor interest. I wouldn't say it has gone to where it should be, but all those signs of early interest are there.
Thank you very much again. Thank you, Nitin. It's been wonderful. We will be emailing out again this evening a video recording of this webinar and plus the slides from Nitin. So it's 6:30 on the dot. We're going to love you and leave you. Thank you so much and have a great evening.
Thank you.
Bye-bye.
Thank you. Thanks, Garth.